Right. Here, specific and general reserves. So here, allowance for loan loss account divided into two parts. So specific reserves and the general reserves. So same as for bad debts or doubtful debts. So normally in accounting we make provision, a specific uh, provision and general provision. Like that, the same principle applies here. So a specific reserves set aside to cover a particular loan. Set aside to cover a particular loan, right? A particular loan, not a common, a particular loan which bear above average risk. So the banks, for example, give loan to Mr. X, and the bank is realized that the recover the loan from Mr. X is a high risk, so they can make provisions to Mr. X. So that in that case it will fall under specific reserves. So set aside to cover a particular loan which bear above average risk, and designate a portion of allowance for loan losses, or add more reserves to allowance for loan losses. And general reserves is common, remaining allowance for loan losses. So it's determined by management. So the amount of specific reserves and general reserves, so it's determined by the management, but is influenced by tax rate, income tax rate, and government regulations. Non-performing loans and miscellaneous assets. Non-performing loan mean the bank is already given loan to particular customers, but the thing is the bank is unable to earn expected revenue, expected interest from a particular loan. So that means non-performing loan. The loan is here but it's not performing. So non-performing loan is a category of loan which doesn't acquire, doesn't generate interest income, or have to restructure to accommodate borrowers change circumstances. The loan is placed in this category which scheduled payment is past due more than 90 days. So the particular customer has not paid the money for more than 90 days. So miscellaneous assets, bank premises and fixed assets. So bank buildings, bank computers, bank networks, bank furnitures, and other equipment, security lockers. So these are the other assets, bank premises and fixed assets. Other real estate owned, right? So real estate investment to compensate non-performing loans, right? And goodwill and other intangibles is coming under miscellaneous assets. So when you look at the bank balance sheet, you can find here it's a typical balance sheet. You can find reserves and cash items, securities, right? Then loan, commercial and industrial loan, and real estate loan, interbank loan, consumer loan, other loan. So the loan represents 74% of total assets. When we look at the deposits, right? So checkable deposits, my current account, non-transaction deposits, deposit with no check writing, and what here small denomination time deposits, other liabilities, borrowings, and bank capital. So I can show you a typical I can show you a typical annual report. Here I am showing you so this is the annual report of Commercial Bank PLC annual 2020, and you can here you can find financial statement here 137. So this is income statement. Here financial position. Here you can find cash and cash equivalent. Normally when you look at the other manufacturing companies balance sheet, you may find here property, plant, equipment. So that may be the larger portion. But here the larger portion is loan. Here loan. What is that? Financial asset at amortized cost. Loan and advances to the other customers. And this one financial assets. Right? So it's a loan, right? And here cash in hand, cash equivalent. So this is for group, commercial bank group. This is for we have to take this one, this column, right? Here look at here this figure, right? This is the large figure. So again 3 zeros, thousands. The all figures are in thousands. When you look at the liability side, liabilities. Here the major portion is what? This one. That is what? Financial liabilities. So deposits. Here deposits. And other borrowings, non-interest, non-deposit other borrowings here. And this one other liabilities. Right? So point of view of a bank and customer. Normally we as individual, as a depositor, when we deposit money in our account, they send us message, the amount is credited. So but normally when we deposit the money in the bank account, we normally treat as an asset, but bank says credited. Why credited? So it's bank point of view, it's a liability, so that's why they call as credited. The bank's point of view, our deposit is a loan to the bank, so it's a liability, so therefore the bank treat as liability. So customer, here banker says the bank will credit your deposit account. Bank will credit your deposit account. So customers view their deposits as assets. It customer's point of view or depositor's point of view as asset. So therefore the customer thinks credit equal assets. Now we look at the bank liabilities. Deposits. So this is the major portion of its liabilities. So deposits. So there are different types of deposits. First one is non-interest bearing demand deposits. Normally it's a current account. Normally current account will not get any interest. So non-interest bearing demand deposits. So permits unlimited check writing, but cannot pay any interest rate, any interest. Second one is saving deposits. So lower rate of interest with minimum size requirement of deposits and permit the customers to withdraw at will. So whenever the depositors need that money, they can easily go to visit the bank, or via the ATM cards they can withdraw the money. For that amount, for that deposits, bank pays lower interest rate or minimum interest rate. Money market deposit account. So it's a flagship, the variable interest rate account. So money market deposit account. So money market deposit account pay competitive interest rate with limited checking privileges. Normally 7 days prior notice is required before withdrawal of cash. Now accounts, negotiable order of withdrawal. Negotiable order of withdrawal account. So negotiable order of withdrawal via interest and check writing facilities. Interest and check. So it's a kind of hybrid account, hybrid demand deposit. So here it's via interest. Banks pay interest on that the deposit, and also that depositor have right to write a check. So the depositor can withdraw the money using the check. And time deposits, normally we call it fixed deposits. So fixed maturity term and stipulated set interest rate. So now already predetermined interest rate it gives. So 1 year interest rate 15%, 1 year, so 5 years interest rate is 16%, like that. And non-deposit borrowings. Non-deposit borrowing. So normally companies, not banks, companies borrow loan from others, so using bank loan or other, so by the means of issuing bonds, like that. So bank also can do such practices. So no reserve requirement or insurance fee required, that reduces the cost of fund and make it flexible, but interest rate is highly volatile. So during the time of financial problem, lenders may refuse to extend credit. So sources are where they can get this non-deposit borrowings. So money and capital market, federal fund purchase, this means what? The government bond purchase, so loan from the government, right? So commercial papers, the bank issues some commercial papers, euro market, and long-term borrowings. Equity capital. Here it represents the owner's share of the business. Financial institutions are the most highly leveraged of all business. Capital accounts normally represent less than 10% of total assets. Right? Capital account, so equity person normally 10% of total assets. And also it includes preference shares, preferred stocks, common stocks. Common stock includes common stock outstanding, capital surplus, retained earning. So retained earning means what? Undivided profit. Treasury stocks and contingency reserves. Off balance sheet items. You might study about off balance sheet items in accounting standards of balance sheet. So off balance sheet items mean there are some transactions which are not satisfy the disclosure requirement criteria. Let's say for example loan commitments, future loans, and bank issues some letter of credit. So that kind of things we cannot observe in the balance sheet or income statement. So banks have converted many of their customers in recent years into fee generating transactions that are not recorded on their balance sheet. Say standby credit credit agreement. So kind of services provided by the bank. For what? The bank pledge to guarantee repayment of a customer's loan received from third party. So what it means simply, in other words, so Mr. X is going to get loan from XYZ company. Mr. X wanted to get loan from XYZ company. That time the banks give guarantee about X, Mr. X financial trustworthiness, capacity of repayment of such loan. So in that services the bank will take some charges. So standby credit agreement, bank pledge to guarantee repayment of a customer's loan received from a third party. Interest rate swap. Interest rate swap, we already discussed swap to hedge the interest rate risk. So they swap their cash flows. So the companies, normally other businesses, to hedge the interest rate risk, they fall under a hedge agreement with bank. For that the bank will charge a service fee. So interest rate swap, bank promises to exchange interest payment on debt securities with another party. Financial future and option interest rate contract. So bank agrees to deliver or to take delivery of securities from another party at guaranteed price. And loan commitments, the bank promise that in future the bank will agrees to grant a loan here. So bank pledge to lend up to a certain amount of fund until the commitment matures. And foreign exchange contract. So a bank agrees to deliver or accept a delivery of foreign currencies. You see the balance sheet here, assets and liabilities. So at any point in time, balance sheet debit equal balance sheet credit. So major component of income statement. So income statement shows how much it has cost to acquire fund and to generate revenue from the use of funds in report of conditions. It's mean balance sheet. Here, so when you look at the income statement, you can find interest income and interest expenses. So interest income include interest and fees on loan, interest on investment securities. And interest expenses, what are the interest expenses here? So deposit interest cost. So customers deposit the money, for that banks will pay interest. So that is deposit interest cost. Interest on short-term debt. So bank may borrow loan. So on that, interest on short-term debt, interest on short-term loan. So these are the major income and expenses of the bank. And non-interest income. Other than interest income, banks sometimes have other source of income. It's more, as we discussed, the banks provide other services for fee. Here, fee earned on fiduciary activities, trust services, future loan commitments, and letter of credit, like that. Service charge on deposits. So normally we are maintaining saving account. So the banks every month charge from us for SMS charges, ATM charges, online banking charges, like that. So service charges on customer deposits, trading account gain and fees. You know that the buy and selling of marketable securities. Additional non-interest income. So invest banking, security brokerage, insurance services. And non-interest expenses. So there are so many employees are working at the bank, so the banks have to pay wage, salaries and other personal expenditures, and they should provide rent for the premises, cost of maintaining properties, rental fees on office space, like that. So provision for loan loss expenses. So So it's expense, right? Provision, like doubtful debt. So extraordinary income. So sometime the bank may sell some sort of its assets. So when you look at the income statement, so you may find net interest income. Net interest income equal interest income minus interest expenses. Interest income minus interest expense. Net non-interest income. Net non-interest income. Simply non-interest income minus non-interest expenses. Pre-tax before tax net operating income equal this value, net interest income plus net non-interest income minus provision for loan losses. So we simply we call it EBIT in other manufacturing companies. So income before ordinary items equal so profit before interest and tax, like that. Pre-tax net profit operating income plus security gains minus tax. Here debits, when you look at the income statement, here debit equal to credit. Over any point of time, all debits equal to credits. Here in the situations, expense is lower than revenue, so this portion is called what? This portion is equal to profit. This portion, so this is profit, and this profit increases in equity. So it's the profit is belongs to the shareholders, owners. So it's increase in equity, and it may be in the form of cash. So then it's equate, right, increase in assets value. So in such a cases, like cost is greater than revenue, so this portion is called loss. This portion is called loss, and the loss is a decrease in equity, so it's decrease in asset value. So this is the typical income statement. So where you can find interest income, interest expense equal net interest income, and minus non-interest income, plus, then total revenue and expenses, provision for loan loss, interest, non-interest expense, right? So this is one typical. Right, I will show you the income statement of a commercial bank. Alright, here you can find interest income minus interest expense equal net interest income. Net interest income. So then we have to add fees and commission income. So it is a non-interest income, and less fees and commission expenses, and net fee and commissions. So net gain or loss from the trading, so they have divided by the functions. So then they will get total operating income minus impairment charges and other loan losses, so it's kind of provisions. Then we will get operating income. So this impairment charge mean what? Losses, allowances for loan loss, allowance for loan loss. So personal expenses means salary, like that, depreciation, amortization, taxes on financial services, like that.